Have you ever wondered how to make your money work for you? Today, we delve into the world of dividend investing. Picture this. You're an investor and you've just purchased shares in a company. This means you own a small part of that company. Now, as a shareholder, you're entitled to a share of the company's profits. These profits, when distributed to shareholders, are known as dividends. Dividend investing is a strategy that focuses on buying shares in companies that regularly pay out dividends. It's like planting a money tree that drops cash instead of leaves. But why, you might ask, do companies pay dividends? Well, it's a way for them to return a portion of their earnings back to their investors. It's their way of saying thank you for believing in them and investing your hard-earned money. So, you see, dividend investing can be a great way to earn passive income. But why should you, as a beginner investor, consider dividend investing? Well, let's delve into the many advantages that make this approach so appealing. Firstly, dividend investing allows you to benefit from the magic of compounding interest. This means that the dividends you receive can be reinvested back into more shares, which in turn generates even more dividends. It's like a snowball effect, growing larger and more powerful with time. Secondly, dividend investing offers the potential for steady income. Companies that pay regular dividends are often established and profitable, providing a consistent and predictable revenue stream. This can be particularly beneficial if you're looking for a passive income source. Lastly, dividend investing tends to carry a lower risk compared to other investment strategies. Dividend-paying companies are usually more stable and less volatile, offering a safer harbor in turbulent market conditions. As you can see, dividend investing can be a powerful tool in your investment arsenal. You might now be wondering, how do you get started with dividend investing? I assure you it's not as daunting as it might seem, especially when you break it down into simple, manageable steps. Firstly, you'll want to start researching dividend stocks. You're looking for companies that not only pay dividends, but have a history of steadily increasing those payouts over time. Think of established companies that have stood the test of time. They're often in sectors like utilities, consumer goods, or telecommunications. Next, you'll want to analyze the company's dividend history and payout ratio. The payout ratio tells you what percentage of the company's earnings are being paid out as dividends. A lower ratio could mean that the company has room to grow its dividends in the future. A high payout ratio, however, might indicate that the company is giving away too much of its earnings, which could be a red flag. It's also important to diversify your portfolio. No matter how confident you are in a company, it's never wise to put all your eggs in one basket. Spread your investments across different sectors and companies. This way, if one stock performs poorly, others may do well and balance out your returns. Now, once you begin receiving dividends, the magic really starts to happen when you reinvest those dividends. This is where the concept of compounding comes into play. Instead of taking those dividend payouts and spending them, you reinvest them by buying more shares of the stock. This means that the next time dividends are paid, you'll receive even more because you own more shares. It's a cycle that, over time, can lead to significant growth in your investment. Lastly, keep in mind that dividend investing is not a get-rich-quick scheme. It's about building wealth slowly, steadily, and consistently over time. It's about being patient and sticking to your strategy, even when the market gets rough. Remember, it's all about patience and consistency when it comes to dividend investing. Before we wrap up, let's quickly summarize the key points about dividend investing. First, dividends are a fantastic source of passive income. They're essentially a portion of a company's profits paid out to shareholders as a thank you for their trust. Next, never underestimate the power of compounding. It's not just about the dividends you receive today, but also the ones you'll earn on those dividends in the future. Remember, research and diversification are key. Don't put all your eggs in one basket. Spread your investment across different sectors and companies. This way, if one stock takes a hit, your entire portfolio isn't affected. Lastly, patience and consistency are your best friends. The stock market isn't a get-rich-quick scheme. It's a long-term game, and dividend investing is no different. Stay the course, keep investing, and over time you'll see the fruits of your labor. With these key points in mind, you are now ready to embark on your journey into the world of dividend investing. Good luck.